Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights, the multifamily and marketing show. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Now, if you're enjoying the show, do me a favor and leave us a 5-star rating and review. And don't forget to hit the subscribe button so you don't miss an episode. Now, today we're going to talk to my guy, Raj Gupta. All right, Raj is the co-founder and managing partner of Impact Prosperity. Raj began investing in real estate and multifamily back in 2008 when he first learned how to navigate through an economic recession, manage risk, and take advantage of opportunistic investments. Since then, he has owned well over 4,000 units in his portfolio, and he's been a full-time multifamily syndicator and asset manager for the past several years. Let's welcome to the show, Raj Gupta.
Thank you, John. Happy to be here with you.
Raj, thank you for coming on the show. It has been an absolute delight to have you on. And I got to say that I feel like this is long overdue, man. We've known each other for quite some time, and I feel like I should have had you on the show way prior to this. And I think scheduling conflicts kind of made that a challenge, but I'm really excited to finally get you on the show today.
Thank you, John. Yeah, no, I appreciate you reaching out. We've been talking about it for a while, and it was good to get your email and asking me to join you on this. So it's long overdue. I agree.
Absolutely. Well, listen, Raj, I kind of went over your bio high level. Why don't you take a minute and give us more context on your background?
Yeah, sure. I my background, originally I practiced law. I was in the Navy JAG Corps for most of that. Even before that, I grew up in the investment world. My father was a financial advisor, and I used to work with him. And after leaving the Navy back in 2004, joined a law firm for a brief period in Chicago, and then went back and joined my father in his wealth management practice, and kind of stayed in the investment world for a while, and got into real estate in 2008, just really right before the economy started to crash, which created a lot of opportunities. And I've been moving up, kind of just scaling up the real estate portfolio, and been doing it full time for about 3.5 years now, full time multifamily syndication, and love it. I've made some career changes there and changes in focus, but love what I do.
No, I appreciate that, man. Listen, one, thank you for all your service, especially going back to your time in the Navy, and your background in wealth financial services, working in the Navy, working as an attorney, up to now being a multifamily syndicator. You've obviously crossed paths with a lot of different people. We have to talk about what's going on in the world right now, especially when it comes to the economy and, the way people are looking at their finances. What are you seeing? I mean, as a former wealth manager, now multifamily syndicator, a lot of people are trying to figure out what in the world they should be doing with their money. Should I keep it where it is? Should I be moving it into a different asset class? What are you seeing? What are you hearing? And what's your take on that?
I think what I'm seeing, and I'm not in that world anymore, where I'm advising clients on their investment portfolios and whatnot. I left that several years ago. But what I'm seeing is, what FOMO is, right? Fear of missing out. And we see what's going on with the stock market. And I think the mistake that people are making is they're understating the risk that's out there. And the stock market made a big drop in March and made a big recovery. But I think there's people that are still putting money into the stock market because they're seeing what it's doing, and they're seeing all these government programs and everything that are helping, obviously. And I think they're understating risk. I think the risk in the economy, I think the risk in the stock market, even real estate, depending on how you do it, I think the risk is higher than what a lot of people are giving credit. And I would just, my feeling is that I think people should be more careful based on the heightened risk environment out there right now.
So obviously COVID is driving that risk that you're talking about. Can you maybe break down where you see that risk and what exactly is driving the risk behind that concern?
Yeah, I mean, let's just take pre-COVID. We were very long in the tooth in the economic expansion, going back to 2009, let's say. It's the longest economic expansion in U.S. history. So this has been, even pre-COVID, valuations have gone up to very high levels in the stock market. Let's just say in the stock market and in real estate, right? Valuations were at basically record levels. Okay. I think in the stock market, it was the second most expensive stock market in history, next to like 1999 during the dot-com craze. And so very expensive and very long in the tooth in terms of the recovery. And, everything is cyclical. So, and you and I have talked about this, but, we know a recession is around the corner at some point. Don't know exactly when, but everything is cyclical, and it had been a very long time since the last recession. And what does the stock market do in a recession? It drops 40%, 50%, 60%, same with, real estate also takes the hit depending on the type of asset class. And so I think, even pre-COVID, it was time to be careful with the types of investments that you were going to make. And in general, what you wanted to do pre-COVID was try to invest in more recession-resilient type of investments. And now, then COVID happens, of course, impossible to predict, and that just accelerated everything, right? I mean, the economy shut down, the unemployment rate went way, way up. And at the same time, we had unprecedented government response and stimulus, right? Way more, it dwarfs what happened in 2008 and 2009. So I think that while the COVID situation is most likely temporary, right? Once the public health crisis gets resolved one way or another, that'll go away. But we still have the cyclical, economic environment, right? And so I think that's still a risk out there. So it's not just purely COVID. I think the stock market right now is extremely expensive. Real estate still hasn't come down too much because of COVID in terms of valuations. We're not seeing a lot of transactions that are showing huge discounts to pre-COVID valuations. So, things are still fairly frothy right now. So as a buyer, as an investor, you have to be very careful. I think whether you're doing real estate or any other investment, you have to be careful not overpaying in a situation where there is a heightened risk environment out there.
Got it. So really, the environment prior to COVID was already, a bit frothy in regards to where we were in the cycle. But having that hit just really magnified, the concerns in the marketplace, the uncertainty, and added more chaos to what could be potentially happening here. And that's kind of changed your outlook as far as where the investment opportunities are and the way people should be looking at their investment opportunities today.
Yeah, for sure. I mean, that's a good way to put it. I think if you look at the last 5-6 years, in multifamily investing in particular, value add was kind of the buzzword, right? So value add investing, where you buy a property, and even if you're paying, a lot for it, because it's had valuations have continued going higher for the last several years. But there was always the opportunity is to put money into renovating units, upgrading the properties, raising rents, and then refinancing and or selling at a significant profit. That was a phenomenal strategy that was very effective for a long time. But, when you're in a situation where 10 million people are out of work or 20 million people are out of work, and we're in a recession and the economy is kind of shutting down and starting to open up again, but, we're in a situation where is raising rents really the right strategy to be underwriting right now when you're looking at a deal? I think probably not, right? I think there's other strategies now that I think, because we're in a different part of the cycle, in my opinion, than we have been in the last 5 years. It also means utilizing a different business plan and a different strategy. So now maybe you'll have some situations where you have motivated sellers and you can buy some distress that, we haven't seen a lot of distress the last 5 years until recently. And instead of value add, maybe you can buy properties at a lower cost basis because of some motivated sellers distress situation where they can't refinance, let's say, and they're desperate to sell. So maybe you can buy things up at cheaper prices. Or maybe there's some distress that's being mismanaged, and maybe it's at 80% occupancy and you can take it to 95 with good management. Those kinds of opportunities. Where you buy cheap enough to where the cash on cash return is still attractive. And look, if there's appreciation down the line in 5 years, that's great, but I wouldn't underwrite what we typically call forced appreciation, right? Where you're increasing rents and increasing property values that way. So I think you got to look at a different business strategy now because we're in a different part of the cycle.
Yeah, and to be clear, you're saying that there's still opportunities out there. You just may need to change your business plan. If you were going in with a value add plan, just assuming you can go in, spend $4,000 or $5,000 in renovations, increase rents by $150. That may not be the case going forward. So you really need to pay attention and kind of identify where the opportunities are. Before we hit record, we talked a little bit about risk versus reward. And what I think I hear you saying is, there's probably more risk in a value add strategy today than maybe there was 4 or 5 months ago. And that really needs to come into consideration when we're evaluating these deals and these investment opportunities. Do you care to elaborate a little bit on that?
Sure. Look, there's a lot of differences in opinion on where we are with the economy and what's going to happen, right? There's people that think we're going to have a V-shaped recovery. There's people that think it's going to go right back down again, and it's going to take a couple of years to kind of climb out of the recession. And I'm more in the latter camp, where I think it's going to take a while for us to really recover. But I absolutely agree that there are opportunities, and there will be opportunities, but you have to be disciplined, and you have to have the right strategy that makes sense based on what's going on out there. And so, for example, like maybe buying a property where the rents are already at market rents, and you were planning on putting in $5,000 a unit in upgrades and raising rents by $100 a unit per month. Maybe that's not the right strategy, but what about buying a property where the current rents are 10% below market just because the seller wasn't increasing rents fast enough? That could be a good opportunity that still makes a lot of sense and generates good profits even today, because you could increase rents not by upgrading, but just by taking it to market and managing the property better, right? So there's definitely opportunities to be had, but is it harder? It's definitely harder. And you have to be more disciplined. You have to underwrite differently. Like don't underwrite rent increases in the first year, I would say. And be conservative with your collections, be conservative with your expenses, and make sure that you're being compensated for the heightened risk, because risk and reward should be commensurate. If you're going to take higher risk, there should be higher reward one way or another. And I think regardless of what your view is on the economy and how fast or slow the recovery is going to be, I think everyone would agree that it's a heightened risk environment. And how that plays out exactly, people have different opinions. But I think that heightened risk environment means one thing simply, is that you got to get compensated for it. You have to have a higher return if you're going to take that higher level of risk, one way or another. And then you have to have some risk mitigation strategies, probably raising some extra capital for reserves. Cash reserves is a better idea than ever. It's always a good idea, but a better idea than ever to mitigate some of that heightened risk.
No, awesome. Appreciate that. And just to recap that, you really hit on a couple of quick things. One is being more conservative in the expense projections when you're underwriting the deals, making sure you have proper cash reserves, and just really making sure that you're properly compensated for the amount of risk that you're taking into a deal. So, you have to figure out what that number actually looks like for you, but making sure that the deal you're doing is going to pencil out. It's a smart deal to do. And you are finding ways to mitigate that risk as much as possible, whether that is maybe holding off on doing renovations right away, whether that is, not factoring in any kind of rent growth year one, maybe even year two, but really just looking at how do you remove the risk in the underwriting and the evaluation of that opportunity to make the deal make sense and make sure that you're comfortable heading into it. Raj, I want to talk a little bit about kind of your portfolio and your strategy, and just the way you look at kind of the market and market cycles. I know a good chunk of your portfolio is down in the Texas market, Dallas, Dallas-Fort Worth to be specific. What are you seeing from a DFW perspective today? Maybe you can just give us kind of a top line overview of DFW, and then specifically, how has that market been impacted over the last couple of months?
Yeah, sure. I think when you're investing in real estate, they say location, location, location. But in multifamily in particular, you want to look at population growth. You want to look at job growth. Basically, strong economic fundamentals, right? And Dallas-Fort Worth has been one of the strongest metropolitan areas in the country for the last, I'd say 10 years. in terms of population growth. And really a lot of Texas has seen population growth, but Dallas in particular, and employment growth. So we see a lot of companies, opening up their, or moving their headquarters there, and a lot of people moving there because the job market has been so strong for so many years. Now, Dallas isn't alone. I mean, there's a lot of places that have strong fundamentals, but the other thing that I look for is strong valuation. So if you're a multifamily investor, you need to be able to buy properties that are going to cash flow okay and generate returns for your investors. And so having a strong economy is great, but if the real estate is through the roof, if you're having to pay, exorbitant prices to where it's not a good investment anymore, there's not enough upside and too much downside, right? Then it's not going to make sense either. So what I look for is a combination of good, strong local economic fundamentals, primarily population growth and employment growth, and then to combine that with good valuations where the prices aren't overvalued. So if you compare it to, like, let's just say, San Francisco or something, where the local economy has been strong for a long time, but the values are so ridiculously high, no investment in my mind would ever make sense, right? And so Dallas has been, in my view, it was the hottest market, most attractive market for multifamily investing the last several years, because it was a really good combination of really strong fundamentals plus, there were still good values to be had, and that remains today.
Appreciate that. And then as you look at DFW as a market, you talked about the population growth, you talked about the employment growth. Break it down a little bit more, because it's still a pretty large metropolitan market, right? And I know that there's a ton of people that are looking at investing in Dallas. There's been a lot of properties that kind of trade hands in that market. As you start to go deeper, for someone who has decided, hey, DFW is a market I want to pay attention to, what's kind of the next layer to that kind of sub-market evaluation or identifying where the right opportunities are going to be?
Yeah, I think the DFW market as a whole is really strong. I think in terms of taking it down another layer is the type of asset class that I would be interested in buying. So because of all the growth in Dallas and many other metros, there's been a lot of new construction, right? So a lot of new multifamily units coming online. And that could be a problem, right? Supply and demand. So if the supply increases, that could have a negative impact on values and prices. And so, I would be very careful investing in, let's just call it Class A type multifamily, which is a newer product, because that's going to compete with all the new construction that's coming online. And so I typically look for Class B type properties, or B minus, let's say, 1980s construction, 1970s construction. You can't build that anymore, right? You can't build any new 1980s product, Class B minus type product. And so the supply is finite, and demand for that more affordable type housing is only increasing as the population grows. And workforce housing, there's a lot of the jobs that are coming in are blue collar jobs where people are making $30,000, $40,000, $50,000, and those are Class B type apartment renters. And so I think that because that growth that a metro like Dallas, Fort Worth has experienced, while it's great, it can also increase risk if you're investing in that new product, Class A, or where you're competing with a lot of that new product, because you may not be able to. You may have to drop your rents, for example, if you have a lot of competition. But when you look at the 1980s product or even 1970s product, there's no new competition really coming on board, and so you can execute your business plan, which let's just say involves raising rents, and it's still not going to be the highest rent in the area, right? Because the Class A stuff's going to be much higher and hundreds of dollars more in rent. And so I just think that that's a safer business plan right now. And so even if you're investing in a very strong market, you still have to have the right business plan and invest in the right type of product where you're mitigating your risk and maximizing your upside.
I appreciate that. Thanks for clarifying. And the other side of that equation, I've talked to some Class A investors, and their argument on the other side is that, while vacancy tends to increase on Class A, especially when you have a recession or some sort of downturn, they would say economic occupancy actually remains pretty high. How do you look at that when you start going from just the physical vacancy to, concessions and bad debt, and really starting to factor in other considerations when it comes to economic occupancy? And I just realized I just said that. Let me actually explain. There's occupancy, physical occupancy, which is how many people actually live at a property. So if you have a 100-unit building, you have 95 people living in it, it's 95% occupied. That doesn't mean that 95% of the people are paying market rent on time each month. So economic occupancy actually tracks what you actually receive in rental income for that month, factoring in bad debt, people who don't pay, concessions if you offer $100 off a first month's rent, things like that. So from your standpoint, how do you start to look at the overall economic occupancy impact when you are factoring in, whether it be a current situation like today, or just in general, if you are kind of approaching, a more conservative investment?
Yeah, I mean, it's a great question. I think that, look, in a recession, every class of multifamily is going to be impacted. So class A, class B, class C. From a economic occupancy standpoint, like you were asking about collections and whatnot. But in general, multifamily stays fairly highly occupied in a recession historically. Now, what happens is, for example, if you're class A and your rents are 1,800, let's say, on the higher end of the scale, 2,000, what happens is in a recession, you may have to drop your rents to keep occupancy up, because otherwise your occupancy might drop to 80% or 75%. And what's the owner going to do? They're going to drop the rents, or they're going to increase concessions and get that occupancy back up again. So I wouldn't be surprised if occupancy, even in the class A properties, does okay. And to your point, the income levels are probably higher, and they may be able to withstand a recession better than, let's say, a class B resident or a class C resident. So I think, you have to look at it case by case. But from my perspective, if we're in a downturn where people's income is dropping, I would feel more comfortable in more affordable housing. So, I think the greatest risk is going to be if in a 5-mile radius, your property is the highest rents, right? Or in the top 10% of the highest rents, right? And as opposed to if you're in the 50th percentile or something, right? There's a lot of properties that are more expensive, and then there's some properties that are cheaper in rents. And in a recession, I feel like I'm going to be in a safer place if my rents are somewhere kind of in the middle, because there's going to be a lot of demand for those units, right? Once you're the most expensive or up there, right? The demand for those units in a downturn, when people kind of hunker down and try to save a little bit and their incomes go down, you might still be able to keep it full, but I think it's going to be more challenging. And again, it's all risk versus reward, right? So I just think that class A properties, while they are going to have a higher income level for their residents, which will help, I think that the risk is a higher risk. And I'm not sure if you're going to get a higher reward in terms of upside in exchange for that higher risk. So you have to balance, risk and reward. You'll hear me say that a lot. I've already mentioned it a lot so far today, but everything is risk versus reward. And you try to find that optimal level where you can get the most upside for the least amount of risk, right? There's always risk, but you want to get the highest return for the least amount of risk. And I think, in my view, it's not that you can't find deals that are class A. Of course you can. But I think in general, if you're making general statements, I think, the class B type assets are going to be more attractive from a risk versus reward standpoint than class A.
No, I appreciate that, Raj. And for those following, class A, that's going to be your new builds, your luxury type new developments, the, granite countertops, really nice apartments. Class B are more of those, late 70s, 80s, maybe even early 90s construction products, solid, great neighborhoods, more working class, but, still desirable. C is going to be more working class, a little bit of an older product, definitely, in good areas, but not necessarily the most desirable parts of town. So as you're looking at that, that's what Raj and I are talking about is it better to invest in these really nice class A luxury type of properties, or in these B2C type assets where it's more workforce, people who are renting more by necessity than choice. I know that class A, renter typically they're making enough money to go out and buy a house if they actually really wanted to. And they're renting because they choose to. Maybe it's because their lifestyle permits it. If they're a single family house, they don't necessarily have children. They don't need to buy a house right now. Maybe their job moves them around, so they want to be a bit nimble and transient from that standpoint. So they're renting for those reasons versus maybe in the Class B, Class C, you're renting to a family of four, and they, maybe have some credit challenges, but make good money, can pay their rent on time, but they're trying to save to get a house, or they're trying to clean up their credit, so they need to rent for a couple of years. So you kind of have that balance of the types of residents you're looking at, and all of this kind of goes into your business plan. And as a part of when you're looking for properties, you also need to understand who's actually going to rent, these assets, who's going to be your residents, who's going to live there, why would they live here, and are you monitoring those things that may change? Because one thing that we've noticed here, especially in the Class A stuff in major urban markets, as you have more and more people who are working remotely, working from home, well, if you paid $2,500 to live downtown so you could be close to work, but now you can work from anywhere, does that apartment still feel worth $2,500, or would you rather pay half that, move a little further out, get a yard or get some space where you can actually expand a little bit? So curious to get your take on that. I know you don't do Class A downtown luxury, but I'm curious, you are in Chicago, and I'm certain that you have talked to people who are certainly having these kind of conversations.
No, I think you're right. Certainly going through this pandemic is going to change behaviors. And, I know you're working on this Midwest Summit that's going to be virtual for the first time. We were just talking about that earlier. And it's, certain, I'm not traveling nearly as much as at all, really, but for years was traveling all the time. And, even after the pandemic is over, am I going to go back to my prior behavior? Probably not quite all the way, to where it used to be. And I think you're going to see more conferences being done virtually even after the pandemic is over. And so there's going to be, people might be flying less, people may be traveling less. So I think there's going to be some longer, semi-permanent changes in behavior. And certainly to your point, if you were paying extra to be closer to work or something like that, I think that that might not make as much sense anymore. But the other thing is people are afraid right now, generally speaking. And I mentioned heightened risk environment, but people are concerned. Their futures aren't so clear as they might have been 6 months ago. And in that environment, people tend to hunker down a bit and spend less, and which isn't good for our economy, because 70% of our economy is also based on spending, right? Consumer spending and consumption. So, we have our challenges ahead of us. And I think, if as a real estate guy, you have to be mindful of affordability and what's happening to people's incomes and their psychology, right? So what are people's risk tolerance right now? I think it's a little bit less. I think people are a little bit more anxious, understandably, than they might have been 6 months ago. And in general, I think that probably means they're going to hunker down as much as possible, probably spend a little bit less, and try to save a little bit more. And that all presents challenges for our economy and for our real estate strategy. Right.
Yeah. I want to talk to you more about that, because it's interesting. I held a webinar recently with a couple of lenders, and they explained that they're actually more busy now than they were previously. In fact, one said, this is the most busy I've been in my 18-year career. And I was a little surprised by that. And he went on to explain that, well, we have some people who are refinancing homes because of the very low interest rates. And we have other people who, after going through quarantine or being, at this stay-at-home order for a couple of months, they realize, I want a nicer home to be stuck in. If I got to be here, I want to be in a place that I'm actually comfortable in, as opposed to this place that was maybe just a place I slept in or came home and had meals in. But if I have to live here, eat here, work here, sleep here, everything, then we got to make some changes here. So I thought that was really interesting. To your point, it seems like there's kind of almost two different worlds happening, where there's people who obviously are very concerned with their jobs, and understandably so, and whether or not the economy is going to stabilize. And there's also people who are saying, hey, listen, I need to change my lifestyle, because if this is the new norm, I need to make adjustments so I can be comfortable going forward. So with that said, I want to talk about investing, and right now I think everyone is trying to figure out is what kind of moves should I be making? We talked about it from a stock market perspective. Let's talk about it from a real estate investing perspective, right? You're a multifamily investor. I'm a multifamily investor. You and I have a little bit of different views right now as far as what we should be doing. Explain kind of your position right now. What are you doing? We didn't really get a chance to talk about Impact Prosperity yet, but talk about Impact Prosperity and how you all are handling, kind of the immediate future. What are you doing right now as far as investment opportunities?
Yeah, look, I think a lot of our conversation thus far has been focusing on the heightened risk and kind of some of the negatives. But we also mentioned that there are opportunities out there. But I would say the other thing that is incredible right now from an opportunity standpoint is the low interest rates that you could, the loans that you can get, right? I mean, in multifamily, you can get a Fannie Mae loan, let's say a 10-year or 12-year loan, long-term debt at maybe 3.2% or something, which is just incredibly attractive. And what happens is, right, that helps with investment returns. So with all the heightened risk out there, you also have this very attractive debt that you can put on these properties. That's going to help with cash flow and returns and whatnot. So there's definitely opportunities to be had, especially if you take into account that lower, very low interest rate that you can lock in for a very long period of time. So, I think from our perspective, like at Impact Prosperity, we are looking at deals. I think right now, because COVID has only been a few months, there's kind of a gap between sellers and buyers, right? I'm looking at it as a buyer saying, hey, it's a heightened risk environment. I need some COVID discounts, as I like to call it. I need some discounts that make it attractive, right, for the heightened risk. And sellers are like, hey, I'm not going to sell it for 20% less than I could have sold it 4 months ago, or 10% less than I'm going to sell it that I could have sold it 4 months ago. And by the way, the stock market is doing really well, and everything seems to be not so bad. The death rate seems to be, from COVID seems to be less than what we were fearing. And so sellers, I think, a lot of times right now are still not willing to discount a whole lot, and they're just going to hold on. And so there's not a lot of transactions going on right now. And so there's a gap. There's a gap between buyers and sellers right now. And until that gap closes by either buyers willing to pay more or sellers willing to take less, we're not going to see a lot of transactions. And so I think, in my view, in order for that gap to close, I think sellers have to get a little bit more motivated, right? A little bit more desperate to sell and bring their price down. And I think it's going to happen at some point, maybe in a few months. They're going to have loans coming due, for example, and they're going to have to either refinance or sell. And refinancing might be tough if collections have dropped in the last few months because of the COVID pandemic situation. And so then they may have to sell. And if they're forced to sell, now they're a motivated seller, and a buyer may be able to get a discount. So at some point, that gap will close, right, between buyers and sellers. And so I'm looking at deals, but honestly, I'm not very optimistic that I'm going to find something right now where buyer and seller will have a meeting of the minds on valuation and pricing. And so I'll look at deals, and brokers send deals, but I really think that things have to get a little bit more scary, and for that pricing adjustment that I think is warranted right now. So we're looking at deals, but honestly, right now what we're focusing on is asset management on the properties that we own. Asset management has been a lot more intense because of COVID, obviously. So we're working very closely with our property management companies in terms of just keeping an eye on collections, trying to incentivize people to pay. For a lot of properties, evictions have been impossible because there's a moratorium on evictions, or the courthouses were shut down for a while. And so, it's a challenge. And I'd say in general, it hasn't been as bad as what we were fearing. That's for sure. But it's definitely more intense from an asset management standpoint. And so we've been spending, I think, more time on that. And then just, communications with investors. We've been focusing more on that, and just a little bit less time than we normally spend on looking at new deals and acquisition. But I think that's going to change. There's going to be a time when we're going to start seeing a lot more opportunities. And again, the debt is so attractive right now that even mediocre deals at higher interest rates, right, will look really attractive at lower interest rates. So we're keeping that in mind as well.
Yeah. How do you gauge that shift? Because the thing you pointed out, and I think this is really critical, is there's a gap between what most sellers are looking for and what most buyers are expecting as a discount. And honestly, I think for many investors, they would say that this gap has been there for the last few years. And they've been, if you've underwritten deals and gotten to the point where you're like, I don't know how this guy is able to buy that for 10 million. This thing only penciled at, 8.8 to me, right? There's been some of that for years. And I think part of the challenge is someone who's still very actively looking at deals and certainly taking in all the stuff that you mentioned in consideration. For me, it's one of those things where, it's tough to gauge demand from other people. Because, there's also an argument that there's been people who have had their money on the sidelines for so long that they have been licking their chops waiting on an opportunity like this. Whereas even if it could just dip a little bit, they can come in and pounce. And now you have some folks who maybe had money in the stock market who are pulling capital out of the stock market. Maybe you had global investors who, were in Australia or Canada or France or wherever, and they're looking at trying to get money into a hard asset like U.S. real estate. So I think part of the challenge is that, if you're just waiting, it's like, well, when do you know now is the right time to get in if you're not evaluating opportunities almost on an ongoing basis? So is there like a metric that you're looking for to know that, hey, there's been a shift in the marketplace? Or is it truly just you analyze deals, you hope, if it pencils out and offers get accepted, now you know that, hey, there's starting to be some shift in pricing expectations and where our underwriting is coming in. But how do you actually measure that?
I think you have to underwrite, because every property is, you're buying a business, and, there's income and there's expenses, and there's, there might be opportunities to reduce expenses. There might be opportunities to increase income. I think you have to look at everything case by case, and the only way to do that is by underwriting it. And then you also have to take into consideration, realistic debt that you can get, which again will make investments more attractive when you can get in at 3% or 3.2%. And so I don't think there's any shortcut to that in terms of assessing opportunities. You do have to underwrite it. Now, once you get very familiar with a particular market, like I am with, Dallas Fort Worth, I can pretty much tell, like, if a broker's presenting me a deal and I'm saying, hey, what's the whisper price on it, right? And they're saying, oh, it's, 110,000 a door, it's 100,000 a door, and it's a 1975 vintage property. Well, I kind of know, right? Based on the market, the sub-market, the vintage of the property, are they discounting it because of COVID, or is that pretty much pre-COVID pricing? And in that example, that'd be pre-COVID pricing. Right. On the other hand, if they're saying, hey, it's 85,000 a door, 90,000 a door, I think I can get the seller to sell at that price. And I know that that'd be 100,000 pre-COVID. Then I'm like, okay, then they're looking at a 10 or 15% discount. At the end of the day, you got to underwrite. But my initial sense is, okay, maybe it's worth spending a few minutes underwriting it because, hey, maybe it's an opportunity. On the other hand, if it looks like the pricing is still pre-COVID pricing, I don't think it's going to pencil out. I'm not even going to waste time underwriting.
That was a great tip there. So definitely understand where you were pre-COVID. So this is why you have to analyze deals. You have to understand, what's going on in the market so you can have something to refer to. If you've never underwritten a deal, it's hard to gauge, what shifts have happened in the marketplace. But if you've been underwriting deals every month, you can start to see, hey, wow, that's about 10% less than this probably would have went for 6 months ago. Maybe there's a deal here. Maybe the market started to soften up, or maybe there's something here with this property that demonstrates that this may be a motivated seller because its price point is actually one that looks more in line with what I would expect. So let's sit here and dig into it. When you think about market dynamics outside of just analyzing the multifamily deals, as you look at the overall economic system and the way the market is shifting, are there other metrics that you're really paying attention to demonstrate, when some of the impacts from the economy is starting to hit? Is there anything with GDP growth or anything else that you're looking at to help you realize, what's going on with the economy?
Sure. I mean, there's certain things that I always look at, even, pre-COVID, like for years. I always look at what's happening with the with prevailing interest rates. So like the 10-year treasury bond, what it's yielding, that tells you a lot about what the market is pricing in terms of inflation expectations, and growth expectations. So like right now, the 10 years at like 0.63 or something, right? Which is percent, right? Which is a very low interest rate historically. And what that tells you is that with all the stimulus, that the government has done in the last few months, that the marketplace is still not expecting a lot of inflation or a lot of growth over the next 10 years because the interest rates are so low. If they were expecting, the marketplace was expecting a lot of inflation or growth to kick in the next 10 years, that interest rate on the 10-year treasury bond would be a lot higher. So I would look at that. I would look at the steepness of the yield curve. You ever heard me talk about that before? Also, just right now, you got to look at employment. Certainly looking at not to get too COVID centric, but you got to look at what's happening with, the deaths and because that's going to impact how quickly the local economies open up, and how quickly the jobs come back. So, I mean, I think right now you got to be hyper focused on employment. And then always you look at corporate earnings, because that's the heart of our economy, right? So you're looking at GDP, corporate earnings, how they're trending. You got to look at unemployment. And this is very like standard macroeconomic stuff, right? 101. Look at inflation, look at unemployment, look at corporate earnings, and then look at valuations in general, right? So look and try to be as objective as you can. So this isn't about a gut sense, right? Look at valuation, look at the PE ratio in the stock market, look at cap rates on multifamily and what you can get something at, what the trend is, if cap rates going up or down. Look at interest rates, are they going up or down? What's happening with inflation, right? So these are, when you look at all of these different things, it kind of paints a picture, like you can get your fingers on the pulse of what's going on with the economy and what's going on specifically with multifamily, right? And it's really important to have a sense for what the macro situation is, because you need to assess what's your upside and what's your downside. If you're going to assess the attractiveness of an investment, if you're thinking about raising money or investing money, you have to have a method to assess it. And you have to have context to assess it. And I think it's really, really critical. I've said this to you before. I think 80% of what makes an investment good or bad is the macro environment that you're making this investment in, and whether that investment makes sense based on what's going on in the macro environment.
Awesome, Raj. Thank you. Appreciate that. Let's move on to our bullseye round. You ready?
Okay, I'm ready.
All right. Give me a failure or an apparent failure that sets you up for later success.
Gosh, a failure, apparent failure. I think, I've given this example before, but when I first started investing in real estate back in 2008, I had a lot of experience with investments, but not necessarily real estate. And I just started buying, in February 27th of 2008. And I bought this 16-unit apartment complex as a foreclosure in East Detroit. It was like the worst part of Detroit. And I was just anxious to get in the game, right, in the arena. And it was a foreclosure. I thought, okay, it's okay. It's a bad neighborhood.
Did you say September 2008, by the way?
February 2008. September's when
February.
Yes,
February 2008.
February of 2008. So it was about 7 months before leaving.
Okay.
But real estate had peaked in 2006. So a lot of people don't realize. And so, there were still opportunities to be had back then. And of course, things got a lot uglier. And then Detroit was, it suffered the most population loss in any metro in the country, right? So, when I was talking about strong local fundamentals, like Detroit didn't have that, right? And still doesn't. But again, you balance that with the opportunity, the values that you can get in at. But honestly, that was not a good investment. And it was extremely challenging from a property management standpoint. A lot of evictions, a lot of people not collecting. But I'll tell you, I never really made a lot. I sold it last year after, 12 years or something, but never made a lot of money. I had to sink money into it, renovating it and things, and always struggled with the demographic and just the crime and things like that, collections. But you know what? I wouldn't be like where I am now if I hadn't gone through that experience. So now, having managed, as a general partner, sponsored, thousands of units. I wouldn't have gotten there if I didn't learn kind of the basic fundamentals of being a syndicator investor from that 16-unit property. I mean, I learned about how to manage the property manager, how to execute on a business plan, which is, renovating and increasing rents, and then increasing collections and improving the quality of the resident profile, and all of that, right? Executing on a business plan and increasing income, reducing expenses, all of that, those fundamental skills that you need to have to be a successful multifamily sponsor, investor. I learned on this small 16-unit property, and it was never a good investment, but it taught me some very blocking and tackling type skills that allowed me to scale and really make some very good investments with that skill set. So I would say that's probably the best first example that comes to mind.
All right, give me a digital or mobile resource you recommend for your business.
Digital or mobile? I don't know. I mean, when you're underwriting deals, I think it's really important when you're looking at a market, especially if it's a new market. But looking at like citydata.com or bestplaces.net, like where you have a lot of data, right? Because I like to rely on data when I'm underwriting as opposed to making emotional decisions. And so you want to look at like median income, median household income, for example, 1 mile, 3 mile. You want to look at per capita income, things like that, right? Understanding the demographic breakdown. What kind of industries are represented in that location, in that submarket, what kind of employers are represented in that submarket. And so a lot of that data is available online, and, utilize it all the time, right? Because, for example, if you're executing on a business plan to increase rent from $800 to $900 a month or $1,000 a month, you really want to make sure that local submarket is going to be able to afford those higher rents. And so, you really want to dive into where, what people are earning in that area within 1 mile or 3 miles, and how many of them are earning enough to afford that higher rent, right? How many thousands of people, or what percentage of the population? And so it's really important that whatever business plan you have, and when you're underwriting, that it's consistent with what you're seeing in terms of the demographics and what's happening in that local submarket, right? And there's, some of those resources are very helpful in that regard.
Give me the book you've recommended or gifted the most in the last year.
Okay, so I'm glad you asked. I have to be honest, there's a book that just came out that I think is one of the most important books that I've seen in real estate for the last several years. And it's published by Bigger Pockets. I actually have it here. It's by Jay Scott. And I don't know, it might be backwards. Is it backwards? No. So it's called Recession-Proof Real Estate Investing. And I just got it. I think he wrote it in March of 2020, like right when COVID was happening. It's a short book, 150 pages. And he calls it recession-proof real estate investing. But what it really is kind of some of the stuff that we talked about, is looking at the economic cycles and making sure that your investment strategy is consistent and mindful of where we are in the cycle. And it's the type of book that, gosh, I wish I would have written, because I firmly believe in it. It's very, very good. I think it's a very important book for people to read. And I think, I give him a lot of credit for putting this together. And it's very timely. And so he calls it recession-proof real estate investing, which it certainly does provide some guidance on that. But it's not just that. It's really every part of the cycle. There's certain types of investments that are going to do especially good when you're at the top of the cycle. There's going to be some that are especially good at the bottom of the cycle, and they're not necessarily the same. They're probably different. And so he actually covers all of that. I think it's I think it's one of the most important books that I've seen come out on real estate investing in several years.
That's awesome. We'll definitely make sure we link to that. I actually was in a mastermind session with Jay Scott out in New Jersey in February? So right before all of this hit. And we talked a lot about, recession-proof investing and the economics and things like that. And I have not had a chance to read the book yet, so we'll definitely make sure we check that out as well. But he's a brilliant guy when it comes to the economics, so we'll definitely make sure we check that out.
For sure.
All right, back here to the bulls around. All right, give me a daily habit that helps you stay focused on your goals.
I think for me, when you're syndicating, especially full-time, there's just so much going on. There's all the different properties, and then there's investor relations and, again, managing the manager. And, you're always focused on executing on the business plan. And then if you're in acquisition mode, always looking at new deals and underwriting new deals. And so there's so much going on that you can't get to it all every day. And so what I do is I just, in the morning, I quickly make a list of things that I want to accomplish that day. And it's nothing super organized. I don't have like some day planner, and I know a lot of people are into that sort of stuff. I just take a scrap of paper and I literally say, okay, these are 3 or 4 things that I need to get done today. And I might have 10 things to do, but I'm going to focus on those, at least getting those 3 or 4 done. And it's kind of just a daily thing that I do, and kind of just keeps me on track, right? Otherwise, it's easy to get overwhelmed with all the different stuff that you can do, and you get spread too thin. But I'm happy if I can get, cross 3 or 4 things off my list every day. And that's basically what I do.
All right, we talked about that Detroit deal. What's one thing you know now that you wish you knew when you were starting out?
I think that's a really good question. For me, it's get in earlier and go bigger, faster, quicker. And, and the reason is because once you know what you're doing, and that's really important, make sure you're educating yourself, read books, get, mentorship if you need it, ask a lot of questions, go to conferences, but, you also learn a lot experientially just by getting into your first deal and your second deal. So I'd highly encourage people to just kind of find a way to get in, partner up, whatever you need to do, get in, learn the ropes, like I did with my Detroit deal. And then, once you know what you're doing, there's no shortage of capital and investors that are looking to invest with smart people that know what they're doing and know how to identify good opportunities. And so once you have confidence that there's no shortage of capital, then there's no reason not to scale faster. And so I think, you sort of always know that, but I wish I had known that sooner, that I could have gone bigger based on my experience and knowledge at that time, gone bigger a little bit faster. And, good investments it's a marriage of capital and opportunity. And if you're really good at identifying opportunity and executing on business plans, that capital will flow through, and you just have to have confidence that it's going to happen. Right? That the capital will come to you once you've established some credibility and some experience and some knowledge. And sometimes it means, if you're less experienced, you partner up with people that are more experienced so that you have that credibility. But I'd say don't be afraid. First of all, if you've never done a deal, to your viewers, if you've never done a deal, really try to get your first deal done. That doesn't mean be irresponsible, but, try to find a deal that, makes sense. Partner if you need to. Maybe it's small. Maybe not. But, I'd say get your first deal done, because you're never going to learn as much as you do by actually being in the arena and actually owning a property. And you're going to learn experientially as opposed to, from other people and from reading books and things like that. So, and then, I would say just be as confident as you can that once you feel like you've got some experience under your belt, scale. Don't be afraid to scale. And there's plenty of people that can help with that and partner with that. And so, that's one thing that I would have done differently. I'm happy. I don't have too many regrets. I'm happy with where I am and the progress that we've made. But I think until recently, I'd say the last few years, I probably didn't scale as fast as I could have.
What are you curious about right now?
I'm very curious about how things are going to play out with the economy and with COVID, honestly, and that's probably not very different than a lot of people. It can go in a lot of different directions. Things can get really, really bad, like they were starting to look in March, April, or maybe with all this government stimulus and support and the gains that the medical community has made in terms of treating the virus and stuff. And maybe it's going to be that it's not so bad. And then it's an election year, so I'm obviously curious about how that's going to play out as well. But, I would say very curious about what's going to happen with the economy and this public health crisis over the next few months. So that's
all right, Raj. Well, listen, let's save our last question here. Something positive, something fun, and as someone who hasn't eaten yet, I'm really hungry right now. So, give me the best place to grab a bite in your city.
All right. Well, you can appreciate this being a guy that lived in Chicago. So, I think Portillo's is like my favorite. Right. And by the way, that company sold, I don't know, a year or two ago for like $1 billion, I think.
Wow.
Privately owned, the family, I think it was the Portillo family. I think they had like 50 something locations in the Chicago area. And I believe it was a north of $1 billion transaction. But anybody that's been in Chicago that's had Portillo's, the best, Italian beef, hot dogs, hamburgers. It's incredible. Yeah, I'm sure you've eaten there, right?
Of course. Listen, if you want a Chicago dog experience, right? I mean, that's the food representation of the city of Chicago is the Chicago style dog, right? So, Portillo's has that. You definitely want to check that out the next time you come to Chicago. And it's a popular one. A lot of Chicago investors come in and talk about Portillo's. I know Josh Inglis has raved about it on the show as well. So, Portillo's is definitely one that people should check out the next time they're in the city. Well, listen, Raj, lots of great insights today, man. I always enjoy talking to you. I love the fact that you brought, so much information around market cycles and market dynamics and just things to be looking for the economy, the way we can try to keep our finger on the pulse of a lot of changes. I mean, a lot's going on in the world. This is moving very quickly. There's a lot of assumptions, but at the end of the day, we don't know what's going to happen until it happens. But if we can look for the right metrics, look for the right information, continue to analyze deals and opportunities and stay on top of it, we'll know kind of when to pulse on opportunities and to really take advantage of what may be out there for us. For listeners who want to get in touch with you, learn more about you, what is the best way to get in touch?
Yeah, they can go to my website at www.impactprosperity.com. I can also be contacted by email at raj@impactprosperity.com, and that's R-A-J. And, we have a newsletter sign up on the website if anybody is interested in signing up for the newsletter and keeping in touch. But appreciate you having me. It was a lot of fun. And, these are obviously very interesting times. And so a lot of, I think, pertinent questions and things to be thinking about right now.
Absolutely, Raj. Always a pleasure talking to you, man. You take care, and we'll talk to you again soon.
Take care, John.